So this is the perfect segue. You just heard what is the most important thing in decisioning in a downturn? Data, data, data. And that's exactly what we're going to be talking about in this panel. So let's start off by just doing a quick round of introductions. Elizabeth, do you mind quickly introducing yourself?
Well, first I want to okay, good. So it works. All right, so that's a good first start to an introduction. Hi there, I'm Liz Billiard. I am the head of consumer credit for BMO.
Hi, I'm Darren Stevens. I'm CEO and Chief Architect of Avado Systems. We're a hybrid integration platform that integrates all the crazy stuff.
Hello, everyone. Patrick Boudreau, Head of Identity Management and Fraud for TransUnion Canada.
Hey, everyone. Lloyd Evans. I'm the CTO with CreditBook.
And I'm Tal Schwartz. I write the Canadian FinTech newsletter, and I'll be moderating this discussion. So to start things off, I want to take us back in time to about a millennium ago, back in 2019, which was the last time we hosted this event. And we have many of the same people, in the audience. So given what we all know now over the last, 3 incredibly crazy years, what advice would you have given yourselves sitting in this audience back in 2019?
I'll take this one. I would say don't panic, lean into the data, and get ready for a wild ride. I think, we all saw this, the panic of those first few months, it was terrifying. Are we able to keep the lights on? But then, it gave us the kick in the pants that we needed to really double down on the models we'd maybe been developing, maybe been talking about developing. And then we also saw that shift in consumer behavior where suddenly all these customers who previously hadn't wanted to share financial data, bank data, et cetera, suddenly they were happy to. And then, and then at that moment, my God, it was off to the races.
Well, I think really I would have looked at having digitization available sooner for many of these processes. Many organizations were caught by surprise, I think, and probably lost a lot of business opportunity as they tried to establish remote, capabilities for their workers and online loan applications and et cetera for their customers. So playing catch up, those that might have had the foresight for other reasons probably would have had greater business opportunities.
Okay, I'm going to continue with that thought because I actually think that's a really good point, that it's almost like what should we told ourselves in 2018, right? It's the preparedness that makes a big difference, I think, in an organization if you're really ready and expecting different types of scenarios. The FICO presentation that just went on, and it talked about a platform. It's how can you ensure that your platform is agile enough, already built for a downturn, already ready to go, so you're making parameter-based changes, not having to rebuild something that could take you 6 months over all of your products. So keep it simple, understand what you want to do, be able to execute. I'm going to do a little bit of a plug, though, for BMO Economics, because I would also say is, listen to your economists. We don't have crystal balls. We were all in the same boat, but what they really talked about was that V type of recession, if you want to call it a swoosh, whatever you'd like to call it at the end of the day. The truth is that the peak of unemployment rates at 13% was a peak that came down. And I do think that gave us a lot of confidence on how we continue to lend. And that would be the other thing I would say. Good point on the not panic. Also, know your customers. You can continue to lend through the cycles. You should be able to continue to lend through the cycles. Your strategies can be built to ensure that you're lending through those cycles, and be there for your customers. If you are there for them in the bad times, they will be there for you in the good times. And I do think a lot of what we did, particularly those early days, and I have to say, because we have a lot of branches, is that we were in our branches for our customers, doing the best that we could do for them during a really difficult time.
So I was going to say this question to the end, but I think it's a good time to ask it now. So, we're sort of on the precipice of another crazy period. There's a lot of economic uncertainty. Rates are increasing. Inflation is increasing. What advice would you give to maybe a head of risk or a head of fraud to go and start bracing for this next period of uncertainty?
I think from an identity and fraud standpoint, I'll take that side and then I'll throw the risk side over, is we don't want to turn any customers away. I think that's the biggest thing. And from a fraud guy, customer experience, you probably don't hear it often, but it is extremely important. And at TransUnion, this is really what we boast, right? Is that friction right, customer experience, user experience, layered with those identity management controls to secure and safeguard your business. Not impacting those customers, not even triggering fraudsters that you're doing anything. It's got to be really passive in the background. With the right data, the right solutions, everything can flow seamlessly, quickly in that user experience. The quicker you get them to that approved state, or yeah, you're in, the quicker they convert, the quicker they turn, and you're not crushing good consumers to catch the fraud.
You want to jump in here?
No, I was just going to say some of the comments that were made on the earlier panels I think are really valid. We're looking at a lot more information sources to understand who our customer is. And there's a lot more information that's available to validate that we're making smart decisions at the time of loan approval to avoid, the fraud and the collection situations afterwards.
So let's talk a little bit more about other types of data. We heard in the last presentation, obviously about FICO. There are tons of different alternative sources of data. I love talking about alternative data because it's such a confusing word, like alternative to what. There's an amazing statistic that I read the other day. Around 59% of lenders are using alternative data in underwriting. So two questions here. One, is that a trend that you guys are all experiencing either at the bank or with your clients? And two, what types of alternative data most excite you?
Well, I guess the interesting thing is the whole world is turning into a service-oriented architecture. So there's really an ability to get information from all these different information sources that are associated with a customer. The better that you know your customer, the better you can meet their needs. A lot of the things that we think about are kind of outside of the stream of what you think about in regular banking. You start to think about social media, you start to think about LinkedIn profiles, you start to think about validation of their spending habits and the other types of information that are just being opened up now and being talked about being opened up through open banking. Jurisdictions like Australia, for example, are opening up utilities and telephone records so that consumers can demonstrate, I may not have a strong credit history, but I'm able to illustrate that I've been paying my hydro bill on time. I can be able to illustrate the amount of money that I can afford as expendable income each month. And especially as interest rates are rising and it's becoming more difficult to acquire customers, I think it's important to be able to look at these alternative sources of information to ensure that you still have a broad customer base that's coming to you.
I'm going to tag on just a little bit on the whole idea of alternative data. I've been working with data for many, many years, and we have had transactional data, transactional credit card, transactional deposits. The credit bureaus report on cell phones, and I know that one credit bureau is even looking at now reporting on rental income. There's a question around one, which is what really is alternative. We have so much information at our fingertips. I think that the challenge is, how do you differentiate from important, valuable data from noise? And I think sometimes you'll find too, when you look at alternative data sources, and I'll go a little bit more out there because you've talked about Facebook and otherwise, that you find that actually may not be as predictive as some of what you would think is considered traditional data. I mean, personally, I would focus very much on real-time, transactional, not necessarily is it alternative or not, but how folks are spending. And really the value is understanding the individual so that it's easier for them to do business for you. For the customers you know the most, they should have the least friction and they should have an easy time to do business.
And that's a great point, Liz. I think when I think of alternative data or traditional data, not to shift it back to a credit bureau view, but that's what I'm going to do. But it's just because historically we've been doing it the same way for years. I think when my dad was in a similar role as me, he was doing credit lending, credit risk the same. We've always looked at the credit bureau as one silo. Lloyd comes in, he applies, we pull his credit file, we match what he's given us to that credit file, everything must be good. It's Lloyd, everything matches. But what we're not looking at is what we own is one of the largest Canadian consortiums in Canada. We have visibility to all Canadian consumers. So what we're able to do and take a look at as an alternative to traditional data, that's a mouthful, is how many Lloyds exist? How many people are at this address? How many people are sharing the cell phone number, the SIN? And that's where the risk starts to go up. Fraud is just the end result of bad identity management. So looking at traditional data in a completely different way and looking at those risk indicators can really hone in on where the identity risks lie to safeguard Lloyd, if it's not really Lloyd applying, and it's Liz on the other side of that computer.
Yeah, and we definitely see that too a lot in our alternative lender data. We see that same thing when those phone numbers keep coming up and that repetition. I mean, that's a huge red flag. But I think now, like with so many just completely different sources of data, the big challenge, particularly for small and like medium-sized lenders, the problem becomes, how do you connect the dots? There's so much data. The volume of it really gets pretty overwhelming. So it's up to vendors like ourselves to help the lenders connect those dots and separate the signal from the noise.
Patrick, I'd like to double click on something you just said there. The connection between fraud and poor identity management. IDV over the last couple of years through COVID has gone through tremendous amounts of growth. Can you talk a little bit about certain trends that you've seen around identity verification, around fraud, and how those two are connected over the last 2 years? And you can guess my next question after that.
Yeah, absolutely. I think over the pandemic, the one thing that did surprise the fraud, executives and leaders in the industry, and I say industries, is that the fraud almost went away. We went down about 40 to 60% in fraud losses over 2021, and in 2022, we're starting to see a little bit of a shift up. And I think that's easily explained with the fraudsters went to the easy money. They went to the government subsidized payments, the SERBs, started opening accounts, applying for 1, 2, 3, 4, 5, 10 payments, knowing that the government had to pivot extremely quickly and do this all digitally. They had no way of tracking this. They were just tossing it out. That's where it all went. So the fraud almost went away. Now they're pivoting back, and they're not attacking the brick and mortars, the face-to-face. They're going digital. Because as I believe Darren or Lloyd was saying, is that the investments, if we go back 2.5 years, invest in your digital channels. Not only for onboarding, for self-serve afterwards, if changes in addresses, changes in phone numbers, those are all extremely high-risk transactions, non-financial transactions that happen. So what we're seeing now is, again, customers are still using, my dad's way of doing things, where it's pull that credit file, do that, ask some out-of-wallet questions, and that's still a layered approach, and you'll hear that from any ID or fraud professional. That's not a layered approach. That is part of a layered approach. A lot of fraudsters now have more information on me than I have on me. When I answer those questions, sometimes I get 1 wrong, 2 wrong. They will get 0 wrong. I guarantee it. So the innovations coming with ID verification, as far as take selfie of your driver's license, passport, selfie liveness detection, that's one thing. But where we really have to kind of push forward is that layer of intelligence. Bring in the data, bring in what I was speaking about before, is that largest consortium view. That's good data. Finding good is the easiest thing you can do as a business. Finding the fraud is difficult. So if you can hone out the good, and I've helped customers find that 98% of the goods, push them through white glove treatment, they turn and they convert faster, then you worry about the 2%. And in there's maybe 1% of fraud, depending on what vertical, what business you're part of. It could be higher or lower. But I think that's the biggest shifts that we're seeing, and not everybody is there yet. So it's still the old way that the fraudsters are semi-easily bypassing.
There's a lot of, there's actually differences in how you treat the same data even these days. Canada has recently made it so that you can apply for a new social insurance number because there's so much fraud going on. There's been so many breaches of that information. So, it's entirely possible that, you have to treat the information in new ways, not just filter out the noise.
And Elizabeth, I saw you nodding along for the majority of that. Can you speak to some of what Patrick and Darren just spoke to, but from the bank perspective, maybe branches have come up several times. How important are branches, like in the context of identity verification and fraud, as borrowers feel more and more comfortable online first?
Yeah, actually, I think that's kind of the point, which is our customers would like to use digital channels. They don't want to have a lot of friction. I can personally attest to the TU questions being very difficult. I have struggled myself. But that said, we're getting better at being able to ensure that we understand who our customers are, no matter what channel they're wanting to interact. And I do think that is part of what we try and do, is that we have multiple channels, whether it be through our contact center, whether it be through digital, whether it be within the branch. So the customer really decides where they want to go, and then we try and use the best information that we have available. And in many cases, it is leaning into credit bureau verification data, leaning into credit bureaus to help us understand who those customers are or who they are not. And then from there, you will have some that are straight through, very easy path, and that is the vast majority. But there will be a couple that we will have to ask a few additional questions to make sure that we weed that fraud out.
I'd like to turn the conversation to best practices. So we have a lot of people in the room who are heads of fraud, heads of risk at credit unions, at alternative lenders, at fintechs, at specialty finance companies. They're all looking at integrating new sources of data, maybe integrating to entirely new data systems. Can you talk quickly about some of the biggest mistakes you see lenders making when they start working with new data sources, new data sets, new systems?
Oh, yeah.
Sure. Oh, you can go ahead.
Go ahead.
No, I think one of the biggest mistakes is thinking that you basically have to throw out the baby with the bathwater and get new systems that can support these new capabilities. The type of technology that our company provides, hybrid integration, is able to adapt to these different applications, to bring in these different information sources, to sit in front of these information sources so that they can be scrubbed, they can be masked, and that privacy can be understood on those information systems, and everything can be made to work as a whole. The idea of actually saying we need a new core banking system because we don't have good API capabilities, these are the sorts of things that turn into billion-dollar disasters. And we have 2 years of lowered customer experience and learning curves and trying to get back to where you were. So the biggest lesson I would say is just to understand that there are ways to adapt applications to make them compatible, to share that information that are low risk and low cost.
I think one of the big mistakes that I see is still a lot of initial integrations. They're still treating it too much as a single point in time. We're using this alternative data at the credit decision point and then forgetting about it. Maybe down the road, maybe you're using bank refreshes if you're lucky enough to not hit MFA, but really it's that initial credit decision and then leaving it at that. I think what we need to change is that mindset and start looking at it more as almost like an event-driven, or for the more technical people in the crowd, publisher subscriber model. When we see that phone number change, and this is my job as the vendor, I should be telling you proactively. This shouldn't be up to some small mom and pop lender to pull a refresh every day and make sure every single field hasn't changed. No, that's up to the vendor. They need to be able to tell you when something of critical importance has happened. And I think that's a mistake that we see a lot. And it's really almost a culture shift that needs to change.
I'm going to offer a little bit of a view on data usage, and one is around raw data. And I do think that there is some importance in curating data, having some sort of standardized view across users so that your modelers, your strategy designers have an easier time using it. I think that sometimes raw data can provide you a lot of insights if you have a lot of missing. So I'm not saying it's not always useful, but there has to be something said about making it easy and also making definitions consistent so that one person isn't seeing one thing and someone else. And you can also increase your errors because folks don't understand the data. And I think that's maybe one of the most important things is we're talking a lot about data, but it's really understanding what are you trying to solve for? What is the customer thinking? What do you think you're looking for? Getting that business point of view, and then also digging into the data and letting the data unfold and tell you a story as well.
Yeah, very well said. And I think there's two things for me. It's more data doesn't mean it's going to be better. It's got to be the right data. You got to use it properly. I think you got to think that through a little bit more. So working with a lot of customers for different verticals, I see a lot of data coming in. There's not marginal lifts. So it's pause what you're trying to solve for and then engage the right partners internally, vendors, your colleagues in the industry. That's a big thing. And then number two, and I feel like I'm going to hammer this every time I talk, is the old way of doing things doesn't work anymore. So there's a time and a place for those questions, and we'll always need them. Are they the number one thing that should be presented right off the bat? No. Does negative lists help with fraud? It did it in 2000. When we came up with negative lists, I was working with RBC at the time, we thought we were the smartest people in the world. We had a bad IP list, bad name list. That has gone the way of dodo. There's more intelligent ways to identify identity risk to stop fraud.
I'd just like to build a little bit on what Lloyd said, which is about the publish-subscribe models, because it's really important in today. Everyone's offering built-in integration with their applications, and I think people don't really realize that how tightly coupled that can make your systems, to the point where it's really impossible to swap out something for the really great something that you want to have that's going to give you that impact with your customers. So using a hybrid integration model where there's an intermediary between these applications makes every one of those connections reusable so that you can pin on that extra data. Now you can have those notifications when the phone number changes by simply multiplexing at that middle tier rather than customizing those applications. And you can get into a world of pain if you get into a situation you've got 80, in healthcare we've seen like 2,000 applications needed for a health authority to be able to manage patient data. The number of connections between that is completely unmanageable. So do think about those event-driven approaches rather than one application knowing how to tell another application to do something. Have that application say something's happened, and have the other application say, oh, I know what I need to do. And that's a scalable model that'll help your information systems to support this.
Tell me you have 2 developers on stage without telling me you have 2 developers on stage.
I'd like to talk just a little bit more about something that you just mentioned there, Patrick. Negative lists. So can we? I think that there's a distinction that probably needs to be made between like first and third party fraud. Is that statement wholly true that negative lists are kind of like 1.0 fraud prevention? Lloyd, I'd also like you to weigh in on this. Is it better for third party? Is it better for first party? And maybe just for the benefit of everyone in the audience, just quickly explain what first party and third party fraud is.
Yeah, first party fraud, the easiest way to explain it is I walk in somewhere, I get a loan, and I have zero intent to pay for it. I'm conducting the fraud. A third party fraud could be I'm acting as Lloyd, compromised cards, those are third party. So I don't want to say that negative lists have no place in fraud prevention. You do need them. Is it your defense? Is it going to stop the fraud? No. What you need those negative lists for, or the fraud tags, is to create models. You have to be able to do the regression. Can you do one-to-one matching and have a strong fraud strategy? No. On its own, it will not provide lift. We've worked with a few, I think a little bit over 10 customers right now, and we ran simulations with what I'm talking about, using more indicators or saying, Lloyd just gave us this address. There's 704 people that have this current address as their active address with TransUnion. There's a problem. So we took more of an intelligent approach, giving triggers, setting it up exactly like you would credit risk. We have attributes, we have models, and we have a score to provide those risks. And what we found is we were able to find 40% more fraud, reduce their operational efforts, so alerts, manual reviews, call-outs, pauses in that process for the customer by 20%. And overall, it was just work less, find more fraud, which was super beneficial. The negative list, or in those simulations we ran with a cluster of customers, they equated to under 5% of the lift overall. So does it provide lift? Yes. It's a few percentage, but the only way we can tune and improve the models moving forward for everybody is to have those tags. So you always need the negative list, but you cannot set up a strategy as to one-to-one match and investigate.
Yeah, I would largely agree with that. I mean, if you have access to real-time information on things like that, that changes it somewhat. Definitely in the space that we mostly focus in, which is subprime, it becomes a lot more. If we get that real-time notification that they just applied for 3 other loans today, or that they just went delinquent on another loan yesterday, definitely we find that super useful. But is it everything? Absolutely not.
Yeah, digital ID, I think, is really going to be key to banking, lending, healthcare, all of these things. We see it, again, to point to Australia, really building on the something you have, something you know, something you are, which would be a password followed by multi-factor authentication requiring a fingerprint to authenticate. This is really going to be key. I mean, you mentioned it's really hard to get all of the answers right, but at the same breath, pretty soon the whole world's going to know your mother's maiden name. So that's not going to last for long.
Sometimes I have to try and remember it myself. That's why the questions can get hard. It's true.
Yeah.
Let's talk now about access to data. So we've established that data is important, real-time data is better. How do you get access to data today? This is an open-ended question, but in the context of open banking, in the context of open data APIs, let's speak a little bit to just that trend over the last few years and maybe where we think that's going to continue going.
I mean, it's exciting times, especially for the larger organizations. We heard this morning, I think it was finance that said they've got 19 different sources of alternative data that they're using. I mean, that's amazing. 10 years ago, who saw that coming? But when we were still taking those paper bank statements, but at the same time, the flip side is that for a smaller lender who doesn't have like that kind of technical resources, it's terrifying. There's so much data that it's overwhelming. So it really comes down to vendor support to make sense of that data and to turn it into actionable insights, really.
Yeah, I'm trying to resist the temptation to tech out a little bit here, but I think one of the key. Thank you. One of the key things is really, the way that we solve these problems and approach these problems is again to separate the implementations from their APIs. And that does a number of things. So first of all, it puts the implementation kind of behind another layer of firewall. So you don't have a database connection for all of your customer service agents where that connection could be hacked and you could get into anything in the database or you could get to the database beside it. Instead, you've got a facade, a service facade in front of that says, all I'm going to do is get customer. That's all I can do. You can hack me. Maybe you'll be able to get customer, but you can't create customer. You can't transfer funds. And that also gives you a benefit of being able to minimize that data noise. Now you're just getting the data that you need from that, and if the information sources behind that change, or if there's new information sources that need to be added to that, that can be done behind that API, which is now separated from the implementation. So you can completely swap out the back end or add on. Now you've got TransUnion, and the other credit unions I won't even mention, and you can just start to enhance that data, and the consumers of that data get more information coming out, more valuable information coming out, but they don't need to change their APIs, they don't need to adapt to new systems, and you're not constantly rebuilding your enterprise. You're able to incrementally add this information and uplift your systems with low risk and low cost.
So it's an interesting question in that different companies are going to have different amounts of information on a customer, right? So I'm coming from one of the larger Canadian banks, and clearly we have very deep customer relationships. A lot of our customers have their full relationship with us, and therefore we do have deep understandings. And some of our issues are more around too much data, right? Having to understand what's important, curating it, making sure it's consistent, easy to use. But I would say that it's also just as important for all of us to think about what data do we have at our fingertips that actually is really important that we may not be fully leveraging today. Because there was a time when we weren't looking at click information before a customer actually came to our website. And now we are able to extend a little bit further and get a little bit more information. We know that the credit bureaus provide some really deep insights, trended data, which is something that provides really good information as far as where a customer is heading, whether they're having some financial stress, where they're not, and then the importance of how you're using it. So you may have silos within any organization. You may have your fraud silo, your risk silo, your collection silo. One of the things that you said that really resonated on, you said, well, fraud isn't that different than risk. Clearly, we're all using data, we're all using information, but what you found was very meaningful in fraud. Maybe the risk manager didn't see it as meaningful, but it doesn't mean it's not. It's just we aren't talking amongst our silos. So I think that there has to be some curiosity, information sharing, silo breaking, and constantly looking one step further out of what information would be useful.
Do you think those distinctions between your credit team, maybe your IDV team and a fraud team, is it necessary today to have those three distinct teams if there is so much overlap? I mean, are they sort of blending together?
Is this the HR panel? I'd say this, and I'm sure a lot of companies do this, but certainly at BMO, we do try and bring cross-functional teams together to have those discussions. If any one person thinks that they've nailed the answer, well, congratulations, that's very special. But mostly what we find is we really nail the answers when we bring people from different areas together. Fraud and risk, we are hand in hand in these decisions. It's a credit loss or it's an expense from fraud, it really doesn't matter. It's a loss. Really understanding that customer, getting that confidence, having that deep information provides you not with only the confidence that they are who they say they are, but the opportunity to say yes to that loan, the opportunity to give them a credit limit that makes sense for that customer, and really help them along their journey, whether it be buying that first home or that first car. We want to be there for all of it.
So last question for this group. Compliance, the sexiest part of the conversation. So I'm in charge of risk. I'm in charge of integrating new data sources to update my adjudication model. What sensitivities are there around integrating different types of data from like a regulatory and compliance perspective? What do I have to be thinking about when I'm making those decisions?
Well, certainly, I mean, you want to start with, Canadian privacy regulations, PIPTA, there's provincial regulations in Alberta, British Columbia, Montreal that override those regulations. I think one of the concerns that I think about with that is we're dealing with applications and fintechs that are bringing in compiled code. So there's not, these are opaque systems, and it's really difficult for a bank or a lender to understand the impact of change on those systems. With the systems we build, we try, or actually I shouldn't say we try, we actually accomplish building these using open standards that are readable, that can be reviewed by the institution. So you don't have that risk of, is this black box now ciphering off a penny of every loan payment or whatever the case might be. It's important, and I think probably a lot of people are bigger experts than I am. I'm not a specialist in fraud or any of those things. I just build systems that need to meet those requirements. So just understanding, customers' right to be able to have their data, understand how you're using their data, how long you use their data. You're informing them, on why you're keeping their data. And following those basic 10 principles, I think you can find just by searching for PIPTA.
Yeah, look, compliance and integrity go hand in hand. And if you want to earn the trust and keep the trust of your customers, you absolutely have to be considering compliance.
Okay, let's end on something a little bit more uplifting than compliance. For everyone in this room, this is your last 30 seconds to impart a little bit of wisdom. We're going into the new year. What is like the one thing that you want to leave someone who's in charge of fraud or in charge of credit risk with going into the new year?
Trust the data. Don't lose faith in it. Trust the data. Nothing has changed that much. With this possible recession, et cetera, the data's going to speak the truth.
As I said earlier, fraud went down over the past year and a half. It's coming back. And everyone's flooding the digital channels now, and even my parents, who weren't necessarily comfortable before, are going through. So there's more traffic, making it harder to find those frauds. So if you want to invest in that digital channel and on that onboarding process.
Don't trust anyone that says integration is easy or that it comes out of the box or that everything is going to work off the shelf. Call Lovato.
That's my mission statement.
Be curious. There's a lot to learn from all different aspects. Be curious.